Alright, for this video I want to go through a sample form 8582 for passive activity loss limitations. And in this scenario we're going to have a taxpayer that has a rental property where he actively participates in the activity. And so he's going to be eligible for the $25,000 special allowance deduction. So we've got the 8582 here. We've got the Schedule E for the taxpayer where we reported the rental income and expenses. And so we'll go through this, the 8582, and we've also got the taxpayer's full 1040 here, so we'll cover all those other schedules and forms that are required. Lastly, we've got one slide here covering some background on the 8582, or rental real estate activities and these passive activity rules. So when we talk about passive activity losses, the general rule here is when you have passive activity losses, you cannot use those losses to offset income from non-passive activities. All right, so all the passive activity income and losses can be grouped together generally, but they can't be used to offset income from non-passive activities like wages or portfolio income, interest and dividends. Now, what is a passive activity? Well, a passive activity is generally one of two things. So first, it's an interest that you might have in a trade or business where you do not materially participate. So for example, if you invest in a partnership and you're a limited partner and that you just contributed some capital, you don't actively run the business, then you likely do not materially participate, so that is a passive activity to you. The other one is rental activity. So rental real estate activities, regardless of your participation level, are generally per se passive activities. So meaning anytime you're kind of confronted with a rental real estate activity, immediately assume that it's just going to be a passive activity unless you meet one of the eligible exceptions. So the first one is the real estate professional election. So the real estate professional election, very tough burden to meet. In order to meet this, you have to spend more than half of your time during the year in real property trades or business, and that amount of time has to exceed at least 750 hours. Now, most people will not attain this election because they don't just get involved in rental real estate activities. They have another job, they have another profession, and so meeting this more than one half your time is often something that they can't qualify for. The other option, which is much more attainable, is the special allowance for active participation. So if you are an active participant in your rental real estate activity, you can deduct up to $25,000 of losses against your non-passive income, subject to certain limitations. And so active participation is a much less stringent and more attainable qualification than material participation, right up here, or certainly the real estate professional election. And so in order to be considered an active participant, you have to do just a handful of things during the year, right? It could be as little as approving a new tenant. And so when you think about rental properties, you might have one or two tenants a year. To approve a new tenant, it's not a lot of time spent. So just doing that in and of itself can get you this active participation qualification. Now, some rules on the AGI here. So your modified AGI has to be below 150. Anything over than 150 mark, and you're not going to be able to get any of the special allowance because it's completely phased out. Now, the current year deductible loss that you can claim is going to be the lesser of 25,000, so it can never be more than 25, or 50% of the 150 minus your modified AGI. And so in our example here with John, he's going to fall within this limitation, 50% of the difference between 150 and his modified AGI. So let's look at the fact pattern here. We have John, taxpayer, bought a single family home as a rental property. He paid $275 and financed 80% of the cost on a 15-year note. The activity generated a net taxable loss for the year of $5,809. Now, John has other income from wages, interest, and dividends, and so his total modified AGI is $146,025. So John's modified AGI is below this 150, but he's going to have to calculate some of the limitations. So if we start with the Schedule E, where we reported the rental income and expense, We can see here we've got the total rents, we've got the various expenses here, and on line 21 we have our net loss on the property. This is our net taxable loss of $5,809. Now once we have this line 21 amount, we can go over to the 8582 to calculate the special allowance, if any. Now remember, the 58, when you stop at this point here, line 21, remember we're going from the perspective 5809, this is a per se passive activity. So immediately think, okay, this is passive unless I can get around that rule. So on the 8582 is where we report all of the income and expense from passive activities, and then we look at these available special allowance exception that might apply. So part 1, before completing part 1, we have to complete parts 4 and 5, right, as it reminds us up here. So if I scroll down here, part 4 is where we report passive activities from rental activities. And then part 5 is where we report all other types of passive activities. So if you had other investments in partnerships, you might report those activities here. But in our case, this is the only activity that John is invested in. So we have our part 4 reporting here. We've got the name of the property, the current year income and loss. We've got no positive net income, but we do have a net loss of $5,809. Now in column C, prior years, this is blank for us because this is a brand new activity, right? He didn't have any prior year loss activity related to this rental property. And then the overall gain or loss is the loss of $5,809. If you have prior year losses, you would add the two together, and that would be the total here in column E. But in our case, we don't have any prior year, so we just have $5,809. Now, once you have the current and prior year values computed here, you can transfer these totals up to part 1, lines 1. So the $5,809 gets reported back on part 1, line 1B. So I'll scroll up here and we report the $5,809 in line 1B. Combine all the amounts and we're left with a total related to rental real estate activities with active participation of $5,809. Now we don't have any other passive activities, so the section 2 here, 2A through D is blank, and so we're left with line 3, a negative $5,809. Now as the prompt asks us here, if line 3 is a loss, which it is, and line 1D is a loss, we can go to part 2. So both of those asks are true. So we'll go down to part 2 where we calculate the special allowance for rental real estate activities with active participation. So on line 4, we enter the smaller of the loss on line 1D or the loss on line 3. It's the same value for us because we don't have any other passive activities. So we've reported the amount there of $5,809. Now on line 5, we've entered the threshold for the year, which is $150,000. And then we have our modified AGI entered on line 6, but this can't be less than 0. So how do we get our modified AGI? Well, we have a modified AGI worksheet for the form 8582 line 6. And so we can see our modified AGI here is really just our wages and our investment income. So if we look at page 1 of John's 1040, he's got a pretty straightforward return, not too many items here. We've just got the wages and then the qualified dividend income, $1,025. He doesn't have any other income items leading up to line 7. So that's his modified AGI. His wages, his dividend income, $146,025. And so that value is reported on line 6. So now on line 7, we subtract line 6 from line 5. We're left with $39.75. And then on line 8, we take half of that, so $39.75 times 50%, and we're left with $1,988. This is the limitation. So for the current period, because John's AGI was close to that 150 limit, he's eligible for this special allowance, but he's not going to be able to deduct all of it. He's only going to be able to deduct up to $1,988 because of this limitation. So we've got the $1,988 figure, and so this is going to be the total loss allowed from all passive activities for the current period. And again, he doesn't have any other passive activity losses or income. So once you've got the $1,988 figure, what do we do with the rest of it? Well, the first thing that we look at is the reconciliation on parts 6, 7, and 8. Okay, so part 6 is completed if we have any amount shown in part 2, line 9. Well, that's certainly us in this case, right? So part 2 is the special allowance. We have a value on line 9, so we have to complete part 6 of the form. So part 6, we have the activity. This is the rental property. It's flowing through from Schedule E, line 22. Our loss was $5,809, and the amount of special allowance that we can claim in the current period is going to be $1,988, which means that the difference, that $3,821, those are losses that they don't disappear. It's just they are suspended as unallowed losses and carried forward to subsequent tax years. And so when we look at the total allowed losses in Part 8, we have the $5,809 of total loss. We've got $3,821 of unallowed and $1,988 of allowed. Now, once the $1,988 of allowed is confirmed, we go back to Schedule E, page 1, and we scroll down to line 22. So line 22 is where we report that deductible piece of the rental real estate loss after limitations from the 8582. So we've got our $5,809 was the total loss. $1,988 is a loss that we're allowed to claim under the active participation test and after factoring in the reduction because of our modified AGI. And so the total loss that we're going to be able to claim on the rental property for the current period, $1,988. So the $1,988 ultimately reported up here on Schedule 1, $1,988, and then that'll flow up to page 1 of the 1040 on line 8. So the rental real estate loss that John incurred for the year, although it is a passive activity, right? Passive activity because it's a rental real estate activity. He is able to claim a small piece of the loss against his other non-passive income, right? So his wages are non-passive, his portfolio income is not passive. And so he's able to claim this loss against these income totals because of that active participation exemption. All right, so that covers it for this video. Hope that was helpful. Any questions, feel free to leave a comment below. And as always, I appreciate you watching, and I look forward to seeing you on the next one. Thank you.